Good morning, everybody, and welcome to our second IFRS webinar for 2020. In this webinar, we're back to my favorite topic, lease accounting. We're looking at ongoing reassessments and modifications. This is where the hard work really starts. As always, I'm joined by my fellow partner in Sydney, Kevin Frobers. Good morning, Kevin.
Good morning, Aletta, and good morning to everybody. Hope you are ready for this presentation.
Thanks, Kevin. So I think Kevin is saying, are you ready? This is really a question of holding on to your seats. I think when we talked, or we've been talking to clients over the last 2 years about implementing IFRS 16. And if you thought that was difficult, I kid you not, the ongoing reassessments, modifications, terminations, new leases, etc., that's really where you have to keep your head together. So in previous webinars, we've done a number over the years, we focused on implementation, and today we're moving on and we're saying we've already implemented IFRS 16. We passed the date of initial application. What now? It's not over. It's not over. So in last month's webinar, we did a recap on IFRS 16, and we used this slide where we talked about the identification of all leases. Have we identified embedded leases in service agreements, etc.? We looked at the challenges around gathering all the relevant information. We also looked at determining the incremental borrowing rate for each lease, and that was a brief discussion because next month in March, we are inviting some of our corporate finance partners to present with us on how to determine incremental borrowing rate. It's turned out to be a real problem, and you'll see when we do ongoing reassessments and modifications, it's an ongoing problem. And therefore, in the month of March, we'll just look at incremental borrowing rate. We also looked at determining the lease term, where we know the IFRS came up with their latest thinking in December, and we've explained that. We've looked at selecting an appropriate transitional method. We looked at the calculations using a technology solution. We've looked at the ongoing management of lease information, and then the reassessments and modifications we've briefly touched on an overview. And this month, the deep dive is on reassessments and modifications. And right at the end, we've got presentation and disclosure. So that's really where we're at. By the way, I just want to say, I forgot to say up front, is if you haven't received the PowerPoint slides or the PDF of the slides via email earlier this morning, on the right-hand side of your screen, there's a handouts section where you can download the slides. So if you haven't received it, I always put it there as well to make it easier. Right. If we now move on to what we'll be covering today, today we look at the ongoing changes to your lease portfolio. And this ongoing changes, I've put in 4 different categories. You could, you've uploaded your lease portfolio on the date of initial application, which would be the beginning of the first year that you implement the standard. And now it's not a set and forget. You could, every month, every day, there could be new leases. And how do we account for new leases? Then there could be remeasurements or reassessments of existing leases. And how do we deal with that? The third category there in blue, there could be modifications of existing leases. So there's changes to the underlying contract. It's agreed changes between the lessor and the lessee. How do we deal with all of that? And then finally, the fourth category, you could terminate some of your leases. So what we'll be doing today is we'll look at the sections here, and we'll start on the left-hand side with new leases. We'll work through each blue category, and we'll end with termination of leases. So in this webinar, we look at new leases, reassessments of existing leases. we look at modifications of existing leases and termination of leases. I should say up front, I'm finding when I speak to people, everybody's just talking about we've got changes to our lease portfolio. And we all understand, things have changed. However, this standard IFRS 16 uses very specific terminology around reassessments versus modifications versus terminations and even versus new leases. So there's a lot of judgment. If I enter into a new lease, is this a brand new lease or is it a modification to my existing lease? And the modification is I'm extending the lease term. So a lot of judgment, and we'll try and highlight some of that during our session today. So I'll start with new leases. Now, new leases in a way is the easy part because on the date of initial application, we've dealt with new leases, but I just want to recap what we do with new leases. So the example that I've put together is we've got a lease and the original lease term is from the 1st of January 2020 to the 31st of December 2025. So it's 6 years. For the first 6 months, it's rent-free. Then for the next 6 months, we are paying $10,000 per month and it's paid monthly in advance. We've got a fixed increase on the 1st of January 2021, a fixed increase of 4%, so that's a year later. And then from the 1st of January 2022, right till the end of that original lease term, we have a CPI adjustment. After the original lease term, the lease also allows for an extension period. And when we first enter into this lease on the 1st of January 2020, it is assessed as reasonably certain that we will exercise this first extension option. It runs for 3 years from 1 January 2026 till the end of December 2028. The payments would be $12,000 per month with CPI adjustments every 12 months. And then the second extension period, again, which we've assessed as reasonably certain to exercise, runs from the 1st of January 2029 to 31 December 2031 for another 3 years. During that second extension period, we've already agreed that the monthly payments will be $15,000 per month with a 3% fixed increase every 12 months. So I've thrown in rent-free periods, fixed increases, CPIs, extension options to just set the scene. What would we do with a new lease? Also, to avoid the issues around determining incremental borrowing rate, because we'll discuss that in March, I've said on the 1st of January 2020, when we enter into this new lease, the incremental borrowing rate is 2.5%. So background, I've assumed for this entity, our reporting date is 30 June every year, which is the case for most of our Australian entities. And 6 months into your first year of adopting IFRS 16, there's a new lease, you enter into a new warehouse, etc. So how do we account for this? Maybe a slightly different presentation. As you know, I like colors and diagrams and stuff. There's the original contract leasing period for 6 years, extension option 1 for 3 years, extension option 2 for 3 years. Altogether, we said we're gonna exercise these extension options, or reasonably certain, and therefore we've got a lease period of 12 years, and our incremental borrowing rate at the start, 1 January 2020, 2.5%. So I think what's really important is for these new leases, at the date you enter into that lease, you have to have your journal debit right of use asset, credit lease liability. And we know it's not always exactly the same amount because there could be costs that we capitalize on day one to the right of use asset. There could also be provisions for make good. There could have been lease incentives. There could be government grants that should be deducted from the right of use asset. But in our example, we've kept it simple. When we enter into this new lease 1 January 2020, we have a right of use asset and a lease liability, or a new right of use asset lease liability. And after that date, for the remaining 6 months of our financial year, we would be depreciating our original right of use assets as well as this one, and we will be making payments. Sorry, this one is rent-free for the first 6 months, but you'll continue to have interest expenses on your initial lease liability as well as this new one. So there's an impact from the 1st of January 2020 ongoing, an impact on additional depreciation and additional interest expense. So what I've used here is I've gone to our technology solution BDO Lead, and I've put this lease into BDO Lead. And this is just a screenshot to make the webinar presentation a bit more or easier to follow. And you can see what I've done with leasing periods. I capture all the data necessary, but for leasing periods, you can see 1 January 2020 to 31/12/2025. Our leasing period, I've put payment rules in. For the extension period, I've put the payment rules in, as well as the second one. And you can see little ticks in these calendars, which means we're reasonably certain to exercise this lease for those extension periods. Then, if you look at the contract leasing period, our initial 6-year period, I've put in the start date, the end date, and there's no termination option. But when we come to payment rules, I've said from the 1st of July to the 31st of December, we're going to pay $10,000 a month. And then from the 1st of January 2021 till the end of December 2025, we're going to pay $10,400 per month, because we know on the 1st of January 2021, our payments have a fixed increase of 4%, so we have to put that in on day one. We ignore future CPI adjustments because we don't know what that's going to be. And the other thing I want to highlight, you will say to me, Aletta, the lease starts on the 1st of January 2020. However, in my payment rule, my first payment is only on the 1st of July, because remember, the first 6 months, we're making no payments. However, we still have to book a right of use asset, a lease liability, on 1 January 2020. So therefore, we'll have to discount those payments to 1 January 2020. So this is just a screenshot on how I've captured the information, the payments for that initial leasing period, and we exclude future CPI as the standard requires. If you go on to the first extension period, which is 1 January 2026 to 31 December 2028, you can see our payment rule for the 3 years is $12,000 a month. Again, it's a CPI adjustment, so we ignore that. It's just $12,000 a month. And if you look at the last extension period, 1st of January 2029 to 31 December 2031, we start and end that period. Our payments are $15,000 a month. It's a fixed increase of 3% every 12 months, and therefore we have to capture it. So fixed increases would be captured, but not expected CPI increases in future. And therefore, if I capture all this data, and I've used BDO Lead, our technology solution, but as we've explained in our master classes, you can also do it in Excel, and we've tried to help you with that. On the 1st of January 2020, in BDO Lead, it says to me, my lease liability on day one is $1.4 million. My asset value is $1.4 million, and we know what the remaining cash payments are. But these are the two numbers we really need to do the journal. And our journal on the 1st of January 2020 would be debit our right of use asset, the 1.4 mil, and credit a lease liability, 1.4 mil. And from this date, we will now start to depreciate this asset over the 12 years. And the lease liability, although there won't be any payments in the first 6 months, every month we'll have debit interest expense and credit lease liability. So if you've got a rent-free period in the first 6 months, your lease liability is actually increasing because there are no payments. So that's just new leases, is a little bit of revision on what we would do with a new lease. So what we'll do here is we now start to get to maybe the more complicated matters of reassessment of existing leases. So if we look at reassessments of existing leases, I've done an extract from the big picture that I've given you earlier. Sorry, I'm just taking a sip of water. When you look at remeasurements or reassessments, the standard allows for 3 types of remeasurements or reassessments of existing leases. The first one on the left-hand side in yellow, there could be a change in our original assessment of the lease term. So it could be because we thought it's reasonably certain to use an extension option, and now we change our mind. We no longer think it's reasonably certain, or it could relate to our assessments around purchase options, termination options. It's important to note that in this situation, when we change our original assessment around these options, it will impact the lease term. And for that particular reason, because it impacts the lease term, we would need to use a new discount rate as of the date that we change this lease term or we change our assessment. So a lot of people have asked me, Aletta, when we upload our leases and we do our calculations, when do we and how regularly do we have to update our incremental borrowing rate? You don't really have to do anything to those incremental borrowing rates until you end up with reassessments or modifications. And only for certain reassessments or certain modifications. And usually you would update it when you start to change the lease term, because we know incremental borrowing rate is intrinsically linked to the lease term. Therefore, in this first one, the change in the original assessment of a lease term, we'll have to use a new discount rate at that date, and we wouldn't expect a P&L impact because if we change the lease term, we would change the right of use asset and the lease liability by the same amount. The second one we have here is a change in estimate of a residual guarantee. Now, that change in estimate of a residual guarantee doesn't impact lease term. So when we change it, we still use our original discount rate that we've used on day one. Again, no P&L impact. This change in estimate of residual guarantee, I've seen in my clients around vehicles where you are making balloon payments at the end of a lease, and the balloon payment is potentially linked to the number of kilometers you travel, and therefore you make an assessment on day one on how many kilometers you will travel during the lease term, and therefore what the balloon payment will be. And it could also be that you update that assessment, and that's when you use still the original discount rate and there's no P&L impact. On the far right-hand side is a situation that you'll see very common in practice, and that is where we have leases with CPI adjustments every year. So it could be there's a change in an index like CPI, or there could be a change in a rate that affect your payments, and it would also include market reviews. Now, this is an interesting area. It really has 3 aspects in there. It could be a change in an index, it could be a change in a rate, and it could be a change as a result of a market review. And as soon as you deal, we know on day one, we deal with the index as on day one, we deal with the rate on day one, and we deal with the market payments as they exist on day one. However, as soon as the rate or the index or the market rent changes in future, we have to make an adjustment. It's still using the original discount rate because it doesn't impact our lease term, and there would be no P&L impact. So at least reassessments wouldn't have a P&L impact, but there's still the question whether I should use an updated discount rate or not. So in our examples, I thought I'll build on to the one that we've had earlier. And in this example, I use the same information as in example 1, but I'm now changing our original estimate of the lease term. And what I've done is on the 1st of January 2021, so this blue circle, on the 1st of January 2021, I'm saying that second extension period is no longer reasonably certain that we're going to exercise that option. So where we originally had the lease term to be 12 years, the lease term is now going to be 9 years. And again, I'm giving you the incremental borrowing rate, and I'm saying the incremental borrowing rate on the 1st of January 2021 is 3.5%. Because we know when we change the lease term at that date, we also have to use a new incremental borrowing rate. So how would we deal with this? So in our technology solution, you would go in and you say, I want to edit my contract. And then BDO Lead would ask you, hang on, edit or change could mean different things. The first one, it could be a reassessment because BDO Lead has been programmed to know what to do with the reassessment. Or it could be a modification, which we'll look at a bit later, or it could be a current revision. Now, that current revision is basically a prior period error. If you've made a mistake in the past and you're now fixing it, then we'll have to flag it as an error under AASB 108. So in this instance, you can't just change a contract in BDO Lead. You have to say why you're changing it. And we would have clicked on create a reassessment. Because we know if we change our assessment of extension options, whether it's reasonably certain to exercise or not, it's a reassessment. And then what we will do, we go to the options tab and we would say, listen, previously we had an incremental borrowing rate. I think it's 2.5%. We changed that to 3.5%. And then the next thing we do is we have to go to our second extension period, and you can see there it says will be executed, and that block you have to untick because we're saying previously will it be executed? Yes, and now we're changing our mind and we're saying no. So there's only two things we're changing here. We're saying we have to use a new discount rate, and we have to use and we have to say we're no longer reasonably certain to use this extension period. So very easy in BDO Lead to go and tick it. And now if you look at the leasing periods, the overview, and I've shown it to you earlier as well, you can see the ticks are now only in the first leasing period and in the first extension period, which means BDO Lead will now only calculate a right of use asset, lease liability, depreciation, interest expense until 31 December 2028. BDO Lead now knows that we have to exclude that last extension period. And therefore, if you run your report, it will tell you on the 1st of January 2021, our lease liability is now going to be less by 476,000, and our right of use asset should be less. So the first thing to do is, what is the adjustment to my lease liability right of use asset on that date that I change my mind? And we would have expected right of use asset to decrease, lease liability to decrease because we're shortening our lease term. Remember, the other angle is the fact that we also have to update our incremental borrowing rate. So this is the journal on that date. I want to flag two things. First of all, I've put it in blue. Prior period figures are not adjusted. All reassessments are accounted for prospectively from the 1st of January 2021. So whatever depreciation we booked from 1 July 2019 up to 31 December 2020, before we made this change, no problem, that stays. All depreciation, all interest expense, all disclosures would stay. But from 1 January onwards, we adjust, number one, our lease liability and right of use asset. But what we now also have to do is we have to redo our amortization table of the adjusted lease liability. We have to redo our depreciation calculation for the remaining lease term. And from this date onwards, we have to have a new depreciation amount, and we would need a new interest expense, etc. So that is the complication, and that's the beauty of a technology solution that does that in the background for you. So that is where we change our lease term. I'll do one more example, example 3. And Kevin, I'm getting tired. Then I'll throw to you for example 4. So example 3 is where we deal with a change in an index, CPI, affecting our lease payments. So again, I'm following on from examples 1 and 2. And what I'm changing is the bit in red is CPI adjustment is on 1 January 2022 and every 12 months thereafter. So we always had that in the fact pattern. But what I'm telling you is in this blue circle, on 1 January 2022, the CPI is now 125 basis points. And if you compare it with the basis points we had when we entered into the lease, I've done the calc for you. It actually means there's a 2% increase in the payment. I think it's really important to understand that although we often talk about CPI as a 2% increase or 3% or 4% increase, to understand that is just shorthand for doing a comparison of what is the basis points today versus the basis points on day one when we entered into this arrangement. So CPI is an index, and we ignore future changes in that index. However, as soon as there is a change, we do factor it in. So how do we factor it in? I've given you the incremental borrowing rate on 1 January 2022. That's unnecessary information. I'm trying to confuse you because if you're not changing the lease term, you don't need to update your incremental borrowing rate for this type of reassessment. Again, when we go, we have to know whether this CPI adjustment is a reassessment, modification, or a mistake, and it's a reassessment. And then we go to our leasing period, and we would say from the 1st of January 2022 till the end of this lease term, 31 December 2025, we're now going to pay $10,608 a month. Previously, it was $10,400, but we've now increased that with a 2%. And you can see we keep it as the $10,608 for the remainder of the lease period or the original lease term. We know it's going to change every 12 months. We wait for that change to happen. At this stage, we're just updating all remaining payments to that amount. And after we've done that, we would again run our report and say, okay, what is our change to our lease liability and our right of use asset? And in this instance, it would lead to an increase in our right of use asset by 9340 and an increase in our lease liability of 9340. Important to note, we would have expected this because if our future payments are increasing, it means if future payments are increasing and we are redoing our calculation, net present value, it would increase our right of use asset and lease liability. The other thing I should flag is some of you would have asked, why did you not adjust your numbers in extension period 1 and 2? Because the payment rules for them run very independently. We've said for extension period 1, we reset to 12,000 and then there would be changes. And for payment 2, in example 1, we reset to 15,000. Quite often they follow one on the other, and therefore you would have had to update your payments in the original lease term and all the extension periods. In this example, I just kept it very simple. The other thing to remember is that prior period figures are not adjusted. All remeasurements are accounted for prospectively from 1 January 2022 going forward. This is the journal on that date. And now again, you have to redo your amortization table, redo your interest expense, redo your depreciation calculation. So again, it's important that you have a technology solution that don't get corrupted when you start to make all these changes and redo tables and multiple tables, and also that you've got a proper audit trail that you can give your auditor. Kevin, I'm going to finish my water and I'll ask you to please look at example 4.
Thanks, Aletta. And I've got to say that was quite a bit to take in. And although I'm doing this along with you for our clients on a day-to-day basis, it made me realize, listening to you, just how much work there actually is in behind the scenes on this. So moving into example 4, this is a change in residual guarantee, and in some ways it's actually a good example just to summarize what Aletta's been talking about, because it encapsulates many of the same concepts. We are still doing a reassessment because we are reassessing a variable or an input into the calculation. And so running through this example, we're just going to take a basic lease of a vehicle, which was a 4-year lease, and there were fixed payments agreed in advance. But in this case, it was a guaranteed residual of $10,000. And this is often with motor vehicles. Your guaranteed residuals in motor vehicle leases will have this estimate of an amount at the end of the lease. In this case, $10,000 on the 31st of December 2023. And the initial incremental rate is 3%. So the fact pattern here is that 2 years into the lease, so on 1 January 2022, we are estimating the change in the residual value, bringing it down from $10,000 to $5,000. Now, I just want to caution here, this is a good example, just like all the others that Aletta have been doing, to remind you that there is a requirement to essentially re-estimate these variables on an ongoing basis. So one should not leave these till the last day or year to then find out you've actually got changes in estimates. And the CPI and the market reviews on property leases, that they generally don't get missed because they actually affect the cash flow as the leases progress. But there are other variables and inputs that go into lease calculations that might happen at the end of the lease, let's say, like a guarantee residual, which may be overlooked in the re-estimation. So please make sure you incorporate those in your processes to identify estimation changes that maybe don't happen every year or more frequently, to make sure you capture those changes as they happen. So jumping into the work that we've done to demonstrate this change, and there are a whole bunch of slides here that I'll run through relatively quickly. So in this case, you can see that Aletta, in her spare time, did this for us. Thank you, Aletta. In our BDO lead product, just to show you how the variables change. And in this case, residual value in the center of the screen was an input right at the start of the lease. At the 31st of December 2023, that was the estimate, or that's the end of the lease. That's the payment date of the residual value. And that would have been captured at the beginning of the lease, at the commencement, at the 3% incremental cost of borrowing rate at the commencement of the lease. So jumping then through the hoops to get this to the end, this screen that Aletta's brought up here is actually just to show you how that payment would have been represented on the 1st of January, right at the start of the lease, or at the commencement date. And you could have seen in our estimations of our cash flows going forward, there was a nice $10,000 sitting there estimated to happen on the 31st of December 2023, and that would have been included in the present value calculation. And what I like about this screen is that you've got this days from the start sitting there of 1,439. So it's telling you that that's the number of days that the payment will be discounted back when you're doing the present value calculation. So because the estimated residual value guarantee is included in the calculation, estimation changes to that must be reassessed and changed if there's a reassessment, which is obviously what we're doing now. All right, so jumping forward, this is the screen, once again distinguishing between a reassessment and a modification. This will be a reassessment. It's not a negotiated change or to the contract, which Aletta is going to get to in a while. It's essentially inputs that change the variable inputs. So Aletta has gone ahead. We've created a reassessment. We've clicked on the reassessment button in our technology tool, and we update the residual value to $5,000. That's our change. At the 31st of December 2023, so that date has not changed because that's still the estimated date of change. And then the question again is, do you have a change in the discount rate? And Aletta had the diagram up before, but you do not change the discount rate on the estimate residual guarantee because you're not repricing the contract. So we don't change the incremental cost of borrowing. And very nicely, our schedule has changed. Now, interestingly, with this one, with the screen that we've got up here, notice how the $5,000 has changed in our scheduled payment. But bearing in mind, this only happened on the 1st of January 2022. So from the previous screen that Aletta had up, time has elapsed. So the only payments that we still have going forward are the remaining payments until the lease expires in 2023 and the residual value guarantee. So this change is happening on the date of the reassessment, which in this case is 1 January 2023. And then moving forward, this will obviously reduce the value of the lease liability because what's actually happening, you've reduced your payment to be made at the end, and that's got to come out of the calculation. What's important here is obviously you've got to work out the present value of the amount that's coming out at the date of the reassessment. And so that's quite important because we know there's been an adjustment of $5,000. It went from 10 to 5. But obviously the amount that you take out is dependent on where you are in the life of the lease and its time value of money component relative to the 3% and to the date of reassessment and the end of the lease. It's quite a mouthful, but essentially you've got to keep this tracked in your technology solution. You must capture your reassessments when the reassessment happens to make sure that the time value of money discounting is appropriately factored in. And then make the adjustment against the right of use asset. I think at this point, it's probably a good idea to just remind you that you've got to watch out for whether you actually have enough right of use asset to cater for this adjustment. So we often talk about the right of use asset get most of these adjustments when the lease liability is adjusted. But if the right of use asset didn't have enough money, enough of an amount in there to cater for this adjustment, you're going to run into a situation where you might have a P&L impact, depending on what you're doing, because the right of use asset here might not have any amount in it to cater for this adjustment. The right of use asset amortizes at a much quicker rate than the lease liability does because of the difference in amortization versus effective interest rate calculation, which is how we do the lease liability. So a number of our clients are running into this problem when they're processing their changes in their reassessments. The right of use asset actually is reduced to zero in this type of adjustment, and then there's a balancing figure that's got to go somewhere, and profit and loss it may be where you take that. So that's just something to also keep track of. It's also another reason why you have to make sure you keep the amortization schedule for the asset and the lease liability separate, because there are two separate accounting concepts that follow them. The one is a depreciation or an amortization concept, and the other is effective interest rate accounting. That's on the lease liability. And so the right of use asset can get reduced to zero in certain situations. So that's example 4. Sorry, yes, Aletta?
I think the other thing that could happen, Kevin, is that this right of use asset might have been impaired in the past. So your lease liability would stand, you've got that commitment, but maybe the right of use asset is in a CGU that's been impaired, and therefore we want to make this adjustment to it, and there's nothing left to credit. So again,
That's
a
right.
P&L impact.
And Aletta, I must say that I've actually run into that a lot in the last few months. Because also onerous contracts or onerous leases can also impact the right of use asset. In fact, that That's what happens when you have an onerous lease. You end up with a possible impairment against the right of use asset, and that can further complicate these types of entries when you actually have reassessment adjustments. So those are very good points to watch out for in practice.
Thank you, Kevin, and thank you for sharing that client experience. I really appreciate that. If we look at modifications of existing leases, so on modifications, that's the next part on our decision tree. I think we should start by just talking about what is a modification. So a lease modification arises from changes to the underlying contract that's been agreed between the lessee and the lessor subsequent to the initial commencement of the lease. So this is different to a reassessment. In a way, a reassessment is where we change our judgment or our mind around extension options, etc. Where with this situation, with a modification, the lessor or lessee get together and they agree to change the terms of the agreement. So the other important point to note is that judgment must be applied to assess whether the extension of the old lease terms between existing parties are treated as new leases or the modification of the original lease. Now, I see this in practice quite a bit. We have a lease agreement for 5 years and no extension options included, just a lease for 5 years. And let's say 3 months before the end of that original lease term, the lessor and the lessee have a conversation around what are we going to do after the 5 years, and they renegotiate, let's say, another 3 years. And now the assessment is that lease for another 3 years a brand new lease agreement? Or is it a modification of the existing agreement where we're saying we're extending the term of the original lease from 5 years to 8 years and we are updating the payments, etc.? It's very important to make that decision, because if you negotiate a brand new lease, you'll run out the 5-year lease, and at the end of the 5 years, your right of use asset is zero, your lease liability is zero. Happy, and we enter into this new lease, and although it's been signed 3 months ago, the new lease commences after the end of the previous lease, and we now do all our calculations of right of use asset, lease liability, and we book it at the start of the next 3 years. So that's one scenario. The one that I see in practice is actually where we have a lease agreement and we renegotiate and we extend our original lease term by adding another 3 years, because people would like the security that they can stay in the premise. And it's easy to say, listen, we add an appendix, we'll stay for another 3 years. This is the new payments based on a market review, etc. Now, in that situation, if we renegotiated this extension period 3 months before the end of the original lease, 3 months before the end of the original lease, we have to account for this modification because the two agreements are intrinsically linked. And therefore, already then do we have to update our right of use asset, our lease liability, as well as our ongoing depreciation and interest expense. I've also included a section from our IFRS in practice on IFRS 16, which specifically addresses the situation. And in the second paragraph, we say, during the lease term, the parties enter into a new lease for the same identified asset that commences when the original lease ends. This change is not accounted for as a separate lease, as it does not convey to the right to use additional underlying assets. The asset in question is the same. Now, in our view, this would be accounted for as a lease modification, which would be accounted for at the date on which the agreement between the lessee and the lessor is modified. the remeasurement would not be delayed until the end of the term on the original underlying lease, since in substance this is a modification to the contractual terms of the original lease. So we're just saying, please be very careful that although you've got two legal agreements even, the substance could be that it's a continuation of using the same asset. And as you know, with leasing, we often talk about the difference between separate legal agreements and substance over form. And this is a good example of that. And I see it quite a bit in practice. So if we look at modifications of existing leases, modifications of existing leases where we agree new terms and conditions. So in certain scenarios, we could treat it as a separate lease. And in other scenarios, it's not a separate lease. Now, this is an interesting concept, especially after what we've just discussed. Now, it could be that I have one legal agreement, and in this legal agreement, I modify our lease to use the same asset and substance over form, it's the same asset. For example, we're currently leasing level 18 of our building in Melbourne, and we enter into or we amend that lease agreement to now also lease level 19. So in that scenario, it clearly is one legal agreement, the lease of level 18 and 19 in future. The question is, will we book this lease of level 19 as a separate lease, or do we have to combine it with level 18 and do the calculations together? The standard is trying to make it a bit easier and practical and says, listen, although legally it's one lease, we could look at it, the lease of level 19 as a separate lease if we meet two criteria. The one is there's an increase in the scope by adding new assets. So level 19 is a new asset, tick. And the second thing, the consideration that we're going to pay for level 19 is a standalone price. So we're not getting a discount because we're already leasing level 18. We are paying market rents for level 19. In that scenario, if you think about the mathematics, whether you combine the two into one lease or whether you keep your existing numbers for level 18 and add the numbers for level 19 as a separate lease, the impact will be exactly the same. And therefore, to make it easier, they say continue with level 18 as you've always done, and now add a separate lease for level 19. No impact. That's an easier way to do it. So to me, it feels like a little bit of a practical expedient, although it's not tagged as a practical expedient. But you have to be careful. You have to make sure that there's an increase in the scope and that the consideration is a standalone price. Because if your consideration is not a standalone price, then we say the price between level 18 and 19 going forward is intrinsically linked, and therefore we should put it together. And important to have a look at that. Also, if there's a decrease in the scope, so if we currently lease level 18 and now we're only going to lease half of level 18, a decrease in the scope, you have to update your discount rate, and there's a potential P&L impact, and or every time there's a P&L impact. So it has to be an increase in scope, and you're paying market values in order to keep it as a separate lease. And it's not because it's legally a separate lease. It's not because the substance is a separate lease. It's just to make it easier, and therefore more like a practical expedient. If it's not a separate lease, so if it doesn't fall into that narrow category, it could be that there's a decrease in scope, or all other kinds of modifications we group together, and we're going to try and illustrate those for you as we go along. So if we look at separate leases, if we've got a modification, that's a separate lease, it can be treated for as a separate lease if the modification increases the scope of the lease by adding the right to use one or more underlying assets. So we're adding a vehicle, adding another floor of a building, another forklift, or the consideration for the lease increases by an amount commensurate with the standalone price for that increase in scope. So we're paying market value for it. If we look at an example on this one, or how would we deal with it? So lessee enters into a 10-year lease for 2,000 square meters of office space at the beginning of year 6. The lessee and the lessor agree, so it's a modification. They agree to amend the original lease for the remaining 5 years to include an additional 3,000 square meters of office space in the same building. The additional space is made available for use by the lessee at the end of the second quarter of year 6. The increase in total consideration for the lease modification is commensurate with the current market rate for 3,000 square meters of office space, except for a discount that the lessee receive, reflecting the lessor does not incur costs that it would otherwise have incurred if the leasing space to a new tenant, so maybe marketing costs. So we're not getting anything else. There's no intrinsic link to the existing lease. The only discount that we get is the fact that they don't have to incur a marketing cost. So in this situation, the lessee accounts for the modification as a separate lease. So our original lease of the 2,000 square meters, we run it down, all our calculations as we previously had, and we now do our calculations separately for the 3,000 square meters. We book a right of use asset, we have a lease liability, we do an amortization table for the lease liability, and we work out the depreciation for the 3,000 square meters. So practically, it's a lot easier to do it this way because really it's separate leases, separate payments that are market related. These requirements are very similar to what we've seen in IFRS 15 on modifications of agreements. You can see I've here used an extract, example 33. It's from our BDO publication, IFRS in Practice. It's a great publication with many, many examples that are very practical. So it's really important. BDO has added a comment in that publication that the legal form of a lease agreement may be modified to add additional assets. In cases where the additional right of use assets are added to the contract at a price commensurate with their standalone price, the modification is in substance a new lease contract, and the modification is accounted for as a separate lease. Think of it as we're trying to help you, or the standard setters are trying to help you to keep it simple. The next one, and Kevin, if I'm right, this is the last section that I'm discussing, and then I'm handing to you and I can rest, is I'm looking at modifications where we have a decrease in scope. Now, a decrease in scope, how would we account for it? We would decrease the right of use asset and the lease liability by their relative amounts compared to the original lease, taking the difference to P&L. So what happens here, if we have a decrease in scope, let's say we previously used level 18 and now we're only going to use half of level 18. The issue that we've got is we have to get rid of half of the lease liability and half of the right of use asset. But if you look at the calculation supporting it, we know the lease liability would have reduced at a slower rate than the right of use asset, because your right of use asset is depreciated evenly over the useful life, where your lease liability reduces quite slowly because initially you're paying a lot of interest. Therefore, if you de-recognize half of the bigger liability and you do recognize half of the smaller asset, there's always this difference. It will never be the same, and that would go to P&L and quite often a profit. Also, you would remeasure the lease liability using the revised discount rate with a set off to the right of use asset. So you would say at this stage, when we decrease the scope, we are repricing. And because we are repricing, we use an updated or revised discount rate. But the effect of that revised discount rate will be set off against your right of use asset. So if we look at an example, in this example, I had entity A has a 10-year lease on 5,000 square meters of office space with annual payments of 100,000 payable at the end of each year. And the rate used to discount the payments is entity A's incremental borrowing rate of 6%, as the implicit rate is not readily determinable. At the beginning of year 7, entity A and the lessor amend the lease by extending it for an additional 4 years. The annual payments remain unchanged, and at the beginning of year 7, the incremental borrowing rate is 7%. So this example, somehow I've still used an increase in the lease term, and therefore it's a modification. There's an increase in the lease term, but I think what we've got here, the annual payments remain unchanged. So in this instance, we would argue that although there's no change in the scope, the lease term is extending, we're not paying a fair price for it, and therefore the modification is not accounted for as a new lease, it's actually accounted for as a separate lease. And the modification is not as a new lease, as it does not convey the right to use any additional assets. The lease is for the same underlying property, and therefore the lease is remeasured using a revised discount rate. And we'll work out what is the liability before, what is the liability after, and we'll have an adjustment to the right of use asset and the lease liability. I have to apologize. I've just realized that this example that I've used is not actually a decrease in scope. The example I've used is a situation where we have a modification that's not treated as a separate lease, but it's actually combined with the original lease, and it's because the pricing is not market related. If we talk about a decrease in scope, before we move on to example 7, the principle would be if you decrease the scope, we're getting rid of half of your liability, half of your asset. The difference will go to profit and loss, and it's important that the lease liability that remains will have to be remeasured using the new discount rate, because we are repricing our payments. Kevin, next one, example 7, I hand over to you, and here we have a decrease in the lease term.
Yeah, so look, I'll deal with this one relatively quickly. The decrease in the lease term, and since we're in the modification stage, this is working through the examples that Aletta has pulled from the guide. It contrasts a previous example. And really, if you think about this one, and I'm just going to go through the fact pattern here, entity B has a 10-year lease, it's 5,000 square meters, and it's not changing what it has access to. All it's doing is going from a period down. So this is essentially a remeasurement of the lease liability prior to the modification. And there's a couple of steps here. The first step is to remeasure based on the decrease in scope, and then remeasure based on the change in the discount rate. So there's a two-step process in this one. Jumping through to the next
Kevin,
slide.
Kevin, I might add that I've had this as a real life situation. A lot of people have thought that a decrease in scope can only be where I'm using less assets or less asset space. And the basis for conclusion in the standard particularly says you can also have a decrease in scope whether you're using the existing asset for a shorter period. So that's why, this is captured as a decrease in scope because the lease term has changed. So it's either I'm using less assets or I'm using the assets for a shorter term. And another thing that's interesting here, we've previously dealt with a shorter lease term, and that was an example too where we decided that it's no longer reasonably certain to use the second extension option. In this case, it's different. It's not a reassessment. We're not changing our mind. This is an agreed change between the lessor and the lessee around lease term, and that's why the outcome is quite different.
I think that's important, Aletta. I think the agreed nature of the change is what's the important takeaway in these examples. Essentially, there's a legal negotiation that's going on here, and that changes the inputs quite dramatically. Aletta?
Yes, no, I'm throwing over to you, Kevin.
All right, good.
Step 1, to remeasure the decrease in scope.
And then, and this is just sort of putting in practice what the last two steps were on the previous slide. So what you're going to end up here is a decrease in scope that's going to give you a P&L impact. In the interest of time, I'm kind of glossing over some of the details, and I'll allow you to go look at that in your own time. And then the second step in this case requires the remeasurement for the change in the discount rate, which is then step 2. And I'll wait for the slides to catch up. All right.
All right.
Let's move on to all modifications. Aletta, are you going to take this one? No? All right.
Yeah, happy to look at it. So I think if we look at Kevin, I cannot hear you. I think everybody might have an issue. If it's all right with you, Kevin, I'll just finish out the presentation. Is that okay?
That's correct. Go for it.
All right. I do apologize. Somehow Kevin is breaking up. So I'll just go back to example 7. I just want to round out the decrease in the lease term. So we've said if there's a decrease in the lease term, it actually is a decrease in scope. It's specifically covered in our basis for conclusion. And in this situation, there's a 2-step approach where we didn't have that with reassessment. So we'll calculate what is our lease liability after we've had the decrease in the lease term, and we'll work out what is the impact of the decrease in the lease term on our right of use asset, and the difference will be a gain. And then the other thing that we'll do is we know that lease liability should now be discounted using the new discount rate because we've renegotiated a new lease term, we've repriced the contract, but that part of the change will not impact P&L. It will actually be set off against your right of use asset. And we've included all the calculations for completeness purposes. When we go to all other modifications, remember all other modifications, we've said some modifications we would treat as a separate lease if there's an increase in scope and we're paying market value. Other modifications we would treat as a decrease, other modifications which are a decrease in scope. I've put it in red, be careful, new discount rate, and there's a potential P&L impact. And we've said that decrease in scope could be we use less assets, or it could be we've got a shorter lease term. If we look at all other modifications, the catch-all bucket, we remeasure our lease liability using a revised discount rate because we renegotiated, repriced this contract. We remeasure our right of use asset by the same amount, and therefore, again, no P&L impact. You would have seen on that big picture that I've given you at the start that it's only a modification as a result of a decrease in scope that would lead to a P&L impact. And that is in most situations. So in example 8, I thought let's look at a modification that increase the lease term. In this example, entity A has a 10-year lease on 5,000 square meters of office space with annual payments of 100,000 payable at the end of each year. Now, the rate used to discount the payment is entity A's incremental borrowing rate of 6%, as the implicit rate is not readily determinable. And at the beginning of year 7, entity A and the lessor amend the lease by extending it for an additional 4 years. And the annual payments remain unchanged. And at the beginning of year 7, we've got a new incremental borrowing rate for entity A, which is 7%. Therefore, in this situation, the modification is not accounted for as a new lease, as it does not convey the right to use any additional assets. The lease is for the same underlying property. Therefore, the lease is remeasured using the revised discount rate. So that is the incremental borrowing rate at the time of the modification. It's not the original rate. And if you look at the lease liability immediately prior to the modification, it was 346, and you'll get that from your old amortization table. If you then work out, so what is my lease liability using the new discount rate, using the new payments over the new term, you can see the new liability is the 597,000, and the difference of 250,619 would increase the right of use as it increased the lease liability. Therefore, at this stage, we are saying we have to adjust depreciation going forward, and we have to adjust our interest expense going forward. And then the last one I would like to look at is, for completeness purposes, we could have termination of leases. So it could be, and that's the last bit, our original lease term was for 5 years. We paid $10,000 per month, monthly in advance. And we've said that we have an increase of 4% on 1 January 2021. Let's say our incremental borrowing rate at 1 January 2020 was 3%. But also that in that original lease term, there was an option to terminate from 1 January 2023 at a cost of 50,000. So if you wanted to terminate, you could do it on 1 January 2023. You'll have to pay 50,000 to be able to walk away and not use the asset for the last 2 years. And therefore, we would capture that in our calculations, and our initial assessment was that it's not reasonably certain that we will use that termination option. So although it's written into our lease agreement, we thought reasonably certain the lease term is going to be the 5 years. Therefore, again, I've used BDO Lead. I've put in the leasing period for the 5 years, and you can see I've captured information around the termination option, that there's an execution value of 50,000, and the payment date would be 1 January 2023 if we decide to exercise it. And then I've got here the termination option is executed. No, it's not executed yet. We're still thinking about it. So that this termination option would not impact our calculations because we don't think it's reasonably certain that it would happen. And therefore, if we work out our numbers, you'll see that we'll have we have our normal journals, debit right of use asset, debit lease liability, 1 January 2020, no problem. However, on 1 January 2023, or one could say the end of December 2022, we could terminate this lease. So if we go to the previous slide, you can see here on the right-hand bottom, there's the option to terminate the contract. And what we're doing there is we're saying, listen, we had that termination option inbuilt. Previously, we didn't think we're going to exercise it. However, now we are exercising it. And therefore, on the 1st of January 2023, we have to remove our lease liability, whatever it is at that stage. We have to remove our right of use asset, and there will be a P&L impact. Again, because your right of use asset would depreciate faster than your lease liability. Therefore, on termination, there would be a P&L impact. And that's really why I wanted to touch on termination. The important thing is you would have seen today that IFRS 16 is not a set and forget. Even after you've done everything for implementation and worked through all the steps we've discussed over the years, the ongoing processing of new leases, terminating leases, reassessments, CPI adjustments, market reviews, modifications is a process. And in order to stay on top of that and have an audit trail and update your amortization tables continuously, an appropriate technology solution would be recommended. Now at BDO, if you've got a lot of leases, we would provide you with software as a service to do all of that, and you'll be in control of the data, or we could do it on your behalf because we've got the technology solution that makes it easier. If you don't have a lot of leases, I mean, we could always do it, but you could try and do it in Excel, and we've explained all of that in our master classes. So I've included some links to how can you find out about outsourcing it, software as a service, and also Kevin and I, due to popular demand, will be scheduling further masterclasses in May and June. We've just completed a series of 3 masterclasses in Melbourne and Sydney, and most of them were really used by entities with 31 December year end. So we're thinking we'll need to do a series for entities with a 30 June year end. Obviously, if you need assistance, we've got a lot of free resources, the webinars, interactive e-learning, accounting news, publications. The IFRS in Practice is an amazing document that BDO Global has prepared. Please feel free to reach out to any of us if you've got any questions. Kevin in Sydney, Clark Gerald in Brisbane, or Wayne and Susan in Perth. And this is the big team, and we're more than happy to help you. I would like to say thank you very much to you and to Kevin for joining me for this webinar. I'm sorry that we had some technical IT issues, especially from around sound, but we hope it was not too disruptive. And we hope you can join us next month where we talk about incremental borrowing rate and how to determine an appropriate incremental borrowing rate. I'll see if Kevin is still there. Kevin, I can see you still there. I'm hoping the sound is back.
I am, yeah. Thank you, Aletta. I can hear you now, and thank you for carrying that to the end.
No worries, Kevin. These things happen. Everybody, thank you very much for joining us. Please give us a call if you would like to discuss BDO Lead or outsourcing your lease management to us. And otherwise, we'll speak to you again next month. Thank you.